Always great to have you, Mohamed. I think the key question for equity investors right now is how much of this new tightening talk and plans, which is very hawkish, is already priced into the market. Bonds are getting it, but the S&P is only 6% off the highs. Is that priced in?
So I think stocks have been incredibly resilient, and there's several reasons why they've been more resilient than the fixed income market. One is they are comforted by the strength of the labor market, and we got another very strong jobless claims number today. Second, financial conditions haven't actually tightened that much, Sarah. As much as we talk about it, we still have very loose financial conditions overall. And third, where do you go? You may not like stocks, but they are the cleanest dirty shirt. Where else are you going to go? So for now, the resilience is totally understandable. I think the market is yet to fully grasp the extent to which the liquidity regime will change. Therefore, you've heard me say, this is a good time to take some chips off the table.
Take your chips off and move what? To cash? To your point, where are you going to go?
Move to the short end of the curve. Take some chips off. Keep most of your exposure still in, but have some dry powder. We've seen the sorts of moves we can get. Look what happened to the NASDAQ earlier. So far, it's been all about interest rate risk, and the equity market has navigated that very well. But keep an eye on credit risk and liquidity risk, because those are much harder to navigate for equities.
Are you talking about the trimming of the balance sheet? What was your reaction to what the Fed announced on that front and how the market could react?
So I think the market is pricing in much more now QT. Two stands as an example of that. The reversal there has been significant. $1 trillion a year, which will not just be passive, there'll probably be an active part to it, is a significant number. So that's something that you've got to take into account. And the reality is we don't have a playbook for this. So we're going to have to stay incredibly agile to navigate through it.
You're sounding bearish, Mohamed. Are you in the recession camp?
So you've known for a long time, I've warned that the longer the Fed is late, and the Fed is very late, the greater the risk that stagflation becomes the baseline, that the right tail of Goldilocks gets pushed way out, and that recession develops into your left tail. And I think that's where we are. Stagflation, lower growth, persistently high inflation. That is now the baseline, unfortunately. It didn't need to be, but it is. And recession is a tail risk. It's not in my baseline, but it's certainly in the distribution of possible outcomes.